All right, I'm going to go ahead and kick it off today. For those of you that have joined so far, thank you. I'm Jennifer Hernandez with Algebrook. I'm the Vice President of Client Success and Account Management here at Algebrook. And we have our two panelists, Deb Dietz, the CEO of Family Financial Credit Union, and then we've got Barb Uphold, President and CEO of United Financial Credit Union, joining us as our panelists today. I'm going to go ahead and kick it over to Andrea to introduce herself.
Hi, everyone. Thanks for joining us today. We appreciate you taking a few minutes out of your day today to join us for our webinar. I think we'll go ahead and just start. But before we dive into some challenges, let's start with the big picture on where credit unions stand today. So because 2025 is an unusual year, and so will 2026, on paper, it's one of the strongest that we've seen in over a decade. Balance sheets are healthy, liquidity is back, confidence is high. In fact, at the beginning of 2025, more than 80% of credit union leaders said that they were optimistic about the next 12 months, and this has carried on over to 2026. That's higher than the pre-pandemic levels. That's a real belief in the cooperative model and in the long game. But the data tells a more layered story. Membership growth is the slowest that it's been in 14 years, just around 2%. And the median number is sadly in the negatives at negative 0.3%. That means credit unions aren't necessarily growing in number, they're growing in depth. The average number relationship is now more than $24,000, which is the highest ever recorded. But there's a hidden downside to that strength. Loan to share ratios have dropped to about 76%, even though liquidity has increased by over 20%. We have more capital, but less movement. Operationally, we're seeing something similar. Operating expenses have climbed from 2.98% to 3.10% of assets, and over half of credit union executives say integration complexity is their top technology challenge. So yes, optimism is real, but so is the strain. The story of 2025 and also 2026 isn't about weakness, it's about imbalance. Growth, efficiency, and connection are no longer moving in sync. That's the tension that we'll talk about today, and how to move from broken progress to meaningful momentum. So now that we've seen the broader landscape, let's look at the first pressure point, which is growth. On the surface, credit union membership is still increasing, but only about 2% year over year, the slowest pace since 2011. But when you look closer, something interesting appears. The average member relationship has reached roughly 24,000, which is an all-time high. What that tells us is that growth hasn't stopped, it's shifted inward. Credit unions are deepening those relationships with existing members rather than expanding their new membership base. Members are bringing more of their finances to one trusted institution, but that shift comes with its own set of questions. When growth relies on depth, the expectations rise greatly. Members expect personalization, seamless digital journeys, and faster access to credit without losing that human sense of belonging that first drew them to the credit union. The opportunity now isn't just to attract more members, it's to provide more value per member, to move from account ownership to relationship engagement. Cornerstone's 2025 report calls this the intimacy gap, where financial institutions know more about their members than ever, yet still struggle to translate that insight into meaningful action. And that's where we believe modern lending, guided by AI, but grounded in empathy, can make the difference. Lending isn't just a transaction, it's the most direct expression of trust. And right now, that trust is being redefined. So what we're hearing from the field, and Deb, this echoes your experience at Family Financial Credit Union, is that growth used to mean acquisition. Today it means activation. You said before that Family Financial is focusing on relationship depth as a growth strategy. Could you share what that looks like in practice? And how are you redefining success when new member numbers flatten, but engagement deepens?
Sure. Thanks for having me today. We're really working on deepening our membership relations, and we need to look beyond just the numbers. It's not about how many member accounts we have, it's about the engagement and the share of the wallet with our members. And we're working really deeply at looking at the personalized onboarding, education on services that they may not know that we're using yet, or may not be using with us yet.
That's great. That's exactly one way to definitely deepen those relationships. And Barb, you're leading United Financial Credit Union in growth mode, but the industry is seeing the slowest membership expansion in a decade. When you planned your lending modernization journey, did you think about volume expansion or relationship depth first?
Yeah, that's a good question. Thanks also for having me today. Appreciate that. Remind me after we're done to update my LinkedIn picture. I think it's probably time to do that. Um, I'm just teasing. Honestly, I think we thought about efficiency first for both our members and our staff, really, which then would lead us to volume expansion by enabling us to process apps faster, automate our underwriting, implement real-time decisioning because we don't currently have that today. The journey that our members and potential members are looking for is built right into Algebraic. And so we basically knew that the new platform would put us into growth mode. We'll be ready. We will be ready.
Awesome. Love to hear that. Thank you,
Mhm.
ladies. Appreciate your input. So let's talk next about the liquidity issue. So credit unions today are sitting on some of the strongest balance sheets in years. As per Q2 reports by the NCUA, share growth rose over 22% year over year, with deposits increasing as members move cash back into insured, trusted institutions. Yet, loan to share ratios fell from 83% to about 76%. That's the largest drop since 2019. So there's no shortage of liquidity, but there is a deployment gap. The problem isn't demand or capital, it's friction in the conversion process. So Cornerstone Advisors 2025 report highlights that 59% of credit union leaders say process inefficiencies and disconnected systems are the biggest barriers to lending growth, not credit risk or demand. That means cash is available, but stuck behind fragmented workflows, duplicate verifications, manual reviews, and outdated integrations. The outcome of this is a slower loan process, frustrated members, and missed opportunities. What's interesting is that even with this friction, members are still seeking loans, especially in auto and personal lending, but decisioning and deployment simply haven't kept up pace with digital expectations. The opportunity now for credit unions is to look at liquidity as movement instead of something static, showing how quickly and confidently capital can reach members who need it. Intelligent automation can't just shorten steps, it needs to remove barriers entirely, turning liquidity into lending speed and lending speed into trust. So, Barb, UFCU's growth has been fueled by strong local deposits and high trust membership base. As you modernize your lending stack, how are you thinking about transforming that liquidity into real lending velocity without compromising the credit union philosophy of personal connection?
Yep, good question. With efficiency, we hope comes more time, right? So by default, it would give us more time to give the personal touch. Even with automation, we would make spending more time with the member a priority. It's been big talk around our shop lately, even at our planning conference, how it's really turning into a human plus digital world. And so we're going to be very intentional about this, keep the personal touch while building and nurturing their trust. Be top of mind always.
Absolutely. I love that answer. People seem to think that AI is going to take away that human touch when it comes to
Mhm.
processes and efficiencies, but it's really not. It's going to give more of that back to be able to build
Right.
those relationships. So that's a perfect answer. So Deb, when you looked at improving lending speed, did you ever worry that automation might just mean faster pushback, not faster approvals, because your loan officer still had to manually catch the exceptions?
No, we didn't. Our lending process is currently fully manual, so which it limits the speed and the accuracy that we can have. So by implementing AI, we'll create the foundation for faster time to market, improvement on our operational efficiencies, hopefully lower cost per loan, and it positions us to be competitive in the market.
Yeah, I love that. I love that. That's exactly what AI is meant to do. AI in lending. That's exactly what it's meant to do. So I'm glad you're seeing that. You're catching on. That's perfect. So I think we are ready for a poll. All right, everyone, get your fingers ready to click a button here. What's your biggest barrier to improving lending velocity right now? So is it speed over connection, automation over understanding, compliance over creativity, cost efficiency over community, or none? If you're one of those very few that have managed to balance both, then congratulations. But I think somebody or a lot of you might fall into one of these other categories. How would you answer this question, Barb and Deb?
I think for me, automation over understanding, maybe.
That's the one that I clicked on, but it wouldn't let me click.
You're special. You can't click on it.
That's right.
Awesome. Do we have poll numbers yet? There we go. Looks like most people they agree with both of you, Barb and Deb. Automation over understanding. Yeah, I think that seems to be kind of the thing right now that everyone is looking to really pursue right now. So that's a great question. Thank you all for your input. I think we can go ahead and move on.
All right, so over the last 3 years, credit unions have made massive strides in automation. We've seen a big jump in digital applications, more AI pilots across underwriting and member service, and new system upgrades aimed at removing the friction. But the unintended consequences is showing up in the data and in member perception. According to Cornerstone, 36% of credit unions have implemented some form of generative AI, and another 29% plan to within the year. That's an incredible pace for adoption, but it's also where the gap begins. At the same time, member satisfaction with digital lending journeys has flattened, and delinquency ratios have quietly risen to 0.90%, the highest since 2020, according to Callahan's Q2 2025 report. So while technology is speeding up, it isn't necessarily becoming more human. Automation has taken out a lot of the friction, but sometimes it's also taken out the feeling. The real risk isn't that AI replaces people, it's that it replaces presence. Because members still want a human tone in their experience, especially when they're applying for something as emotional as a loan. The future of lending isn't AI versus humans, it's AI in service of humans. AI that guides loan officers to make faster and fairer decisions. AI that explains approvals clearly so borrowers understand the why and what they can improve. AI that extends advisor availability without replacing the advisor. We always say empathy is the true currency of credit unions, and when automation is done right, it shouldn't mute the empathy, it should multiply it. So I'm going to ask a question to Deb. You've often talked about how your lending team blends automation with empathy, making tech invisible so the member feels seen. How have you managed that business at Family Financial, and where do you see the biggest risk of automation crossing that line?
Well, I think that, we're looking at it that we're going to use the tech for the speed, not for the relationship with the member. The automation part will handle things like the forms, the checks, the approvals, so the member gets the quicker service. But we keep people where they matter, and when decisions are big or emotional, a real person, a real loan officer steps in to listen and to explain.
Yeah, I love that. And I do think with more automation, it opens up more time to have the conversations
Right.
and really deepen the relationship with them. So I love that answer. Barb, what costs you more today? Members abandoning mid-journey or loan officers second guessing decisions because the rules aren't consistent?
Well, for sure, a little bit of both. But I would say and we can't even currently measure this in our current system, but we believe members and non-members alike are abandoning mid-journey. As you know, it's a real problem. Our abandonment rate is much higher than I would even like to say to you today. We get a good number of withdrawn or incomplete apps. So we do see the new system as an opportunity to fix this problem because of the workflow and seamless integration, the helpful agent built in, especially with the agent. We're hoping to eliminate this friction point and in the end being able to measure efficiencies from a cost perspective.
So,
Yeah, and
Barb,
another,
why do you
go
think
ahead.
you've seen why do you think you've seen a large number of drop-offs
You know,
recently or up to
I
this
just don't
point?
think, yeah, I don't think our system is very wonderful at all. I think it's
I
slow and it's clunky
we're on the
and
same system, so.
yeah. So we feel it,
That
yeah,
makes sense.
and our members are just getting frustrated, and we're learning, and we can measure how many people are going to the site, but we currently can't measure where they drop off, but clearly they're dropping off because they're not continuing the journey.
But can you see when they start an application? You just can't see where they drop off in the journey.
Correct. Yeah.
Okay. Yeah, that would
And
be
I love
helpful
that
to know.
because, yeah, and I love that because once you guys go live, we'll be able to identify that. And if
Mhm.
it's because we're asking too many questions, we can help make a change to that workflow so that you're not experiencing that drop off. So that's great. It's like it's happening, you don't
Yeah.
know when or why. So
Yeah,
so
the analytics that Algebraic has built in are gonna just be a night and day for us.
Yeah.
Very exciting.
So before we move on to the next slide, I just want to remind everyone who's joined through Zoom to enter any kind of questions in the chat to help us with the Q&A. Feel free to ask away. So I just want to throw that out there. All right, so we're going to move on to the next slide. The last challenge is one most leaders recognize instantly because it's hiding in plain sight. Over the past 5 to 7 years, credit unions have added technology much faster than they've integrated it. A CRM here, a digital loan tool there, another plugin for verification, a separate dashboard for analytics. It each fixes a local problem, but it creates a bigger system problem. The result is what we have jokingly called the Franken stack, a patchwork of tools that don't speak the same language. According to Cornerstone Advisors' 2025 report, 61% of credit union executives say integration complexity is their biggest tech challenge. Nearly half are operating with 5 or more separate systems across the lending workflow, each one adding maintenance, reconciliation, and overhead. That disconnection hits the bottom line. Operating expenses have risen from 2.98 to 3.10 of assets year over year, the steepest jump in recent years. Even more striking, IT spending grew 14%, yet output didn't keep pace. The cost of complexity is now higher than the cost of capital. Every vendor meeting, every manual data sync, every duplicated process erodes the efficiency digital transformation promised. And it doesn't just slow loans, it slows people. Loan officers spend more time managing systems than serving their members. The next phase of innovation isn't about more automation, it's about orchestration. A single unified platform that connects origination, decisioning, servicing, and analytics, turning today's scattered stack into one seamless conversation. That's how you restore what automation alone can't deliver, the flow. When the stack moves as one, lending moves as one. So Bart, United Financial has been on a journey to simplify moving from multiple legacy tools toward a unified platform approach. What was the tipping point for you to say enough fragmentation? How are you measuring the impact, not just in time savings, but in how it's changing the member experience?
When was the tipping point? It's a good question. So I think it probably we did a core conversion about 3 years ago, and we needed to recover from that, I guess, first. And then as we as we moved along, we were definitely feeling the pain of a pretty fragmented system. So it's kind of like training new employees on multiple systems to complete a task that should be completed within one system. So our idea is to once again remove multiple steps from the process. We're not quite live on the Algebraic system yet, but we know for sure the member experience will vastly be improved by having their journey remain in one single application, thus speeding up the entire process. One site for all applications to come into, and to reduce dual entry. I like the name of the Frankenstack. I feel that.
Yeah, and I think that your lending teams and your IT teams might also like the fact that they're just actually managing out of one platform versus 10 different platforms too. That was always a headache.
For sure.
Oh yeah, logging into one, logging into another. Did I put this information in this system? Oh, I forgot to put it in this system. It's just,
Which
it's
system am I on?
overwhelming. Yes, yes. And then when reports come, oh, I forgot to put it here. I forgot to put it there. It's just, yeah, it's Frankenstack for sure.
And
scary.
as changes happen, you need to make a change here. It's not going to break all the other systems too. It's all managed within one system, and that's what is, you know, really big impact to credit unions. So Deb, at what point did you realize that integration was no longer enough and that you needed a platform where context, documents, and decisions actually travel together without being rekeyed?
You know, that was at the beginning of our journey for the new LOS, is that we didn't want to patchwork quilt everything together. And we talked to you Algebraic about this, is that you know, there's so much time spent rekeying data between systems. You put it there, you put it here, and you might miss something. So we just wanted our team to be able, and our loan officers to be able to combine it all together, have it in one place, and that, you know, the platform, we needed a platform where everything travels together, the data, the documents, the decisioning, all in one place.
Yeah,
I
I
love that.
remember.
That's exactly what we'll do.
Yeah, I remember that conversation we had, Deb, is how frustrated you were with your current platform and how you just wanted everything to be in one spot. You wanted everything to be nice and simple and easy and not have to go from system to system. And I knew after that first conversation, we had something special to offer.
Yeah.
Awesome. So I think we have another poll.
Yep, we're ready for a poll now. So we can pull that poll up real fast. So this will be interesting. When you were evaluating new lending technology, what was the hardest part to access? I feel like there's multiple answers to this one.
It could be, yeah. So let's see. The hardest part to assess, was it faster approvals, fewer member touch points, quicker understanding and empathy, real-time insights and confidence, or all of the above, but only if it feels human?
So yeah, Deb and Barb, since you guys can't select one, which one would you pick?
Oh, I don't know. It's kind of all of the above. I mean, when you think
I was
about
going
it,
to say too.
yeah, it's all of the above.
Definitely every one of those could be checked.
Yes.
And it depends on who's actually, what area it's impacting within a credit union. So if it's accounts, it could be one
Right.
answer. If it's loans, it could be another answer. If it's IT,
True.
it could be something totally different.
That's true. All right. Do we have our answers yet?
Yep, everyone agrees.
So we've got a few that said fewer member touch points. We had a few that said real-time insights and confidence. Most everyone said all of the above, which we kind of assumed. So that's interesting. Some people chose fewer member touch points above all the others. So I think that's interesting. All right, well, let's move on. So we've talked about the big problems, slower growth, tighter liquidity, and technology that sometimes makes us faster, but not necessarily better. Now let's shift gears a little bit. Let's talk about how credit unions are deciding what comes next. Because every credit union in this room, including Family Financial and United Financial, is standing at the same crossroads. The question isn't whether to automate, but it's how to automate without losing your voice. What we're seeing now is that the way leaders choose technology has changed. They're not just looking at features or speed, they're looking at a fit, at whether a system understands their members, their people, their lending culture. And sitting on this side, as a partner who's watched dozens of evaluations over the last year, we've noticed something interesting. The buying process is evolving faster than the products themselves. The conversation isn't just about efficiency anymore, it's about clarity. Credit unions like Family Financial and United Financial aren't asking, can it automate? They're asking, can it align with the way we lend, decide, and build trust? That's what inspired this next part and what we're calling the lending maturity map. It's a way of organizing what we believe credit unions should be evaluating and what we've seen leading ones do already. We'll walk through our perspective list and then bring in Barb and Deb to share how these ideas show up in their own decision-making journeys. When we sit with leadership teams that are deep in vendor evaluations, the conversation almost never begins with AI or automation. It begins with someone asking, what kind of lending experience do we want to provide? That question matters because technology doesn't just run your process, it shapes your culture. The data we've seen this year from both Callahan and Cornerstone shows a clear tension. Record optimism among credit union leaders, but rising operational cost and member drop-offs. It's not that we've chosen the wrong tools, it's that we've been measuring the wrong things. The first real question that forward-thinking credit unions are asking is, does this make the journey feel human even when it's digital? Because speed means nothing if the member feels unseen halfway through. The second is, does it give loan officers more presence, not just more buttons? We've watched automation promise efficiency, but deliver fatigue, more dashboards, more clicks. The best credit unions flip that. Their technology gives loan officers their time back so that they can return to building relationships instead of just processing. The third, does it connect the story from click to conversion to credit? Too many systems still make the member repeat themselves at every stage. When context travels with them, trust grows naturally and the loan moves faster. And finally, will it grow relationships, not just originations? Because growth today isn't about adding members, it's about deepening the value you deliver to the ones you already serve. These 4 questions have quickly replaced the old RFP checklist. They're what leadership teams now use to decide not which platform to buy, but what kind of lending experience they want to build. Later in this session, we will talk through our unified journey. You'll see how these same questions became design rules for every part of that experience, for members on one side and loan officers on the other. So, Deb, when you began shortlisting solutions, which of these 4 questions guided your internal discussions the most, and what shifted after you asked it?
Well, I think the biggest one that when we look at these questions is that will it grow relationships, not just originations? When we ask that question, we stopped and looked, we stopped looking for tools that not only processed loans and started looking at the platforms that link the data, the documents, the decisions seamlessly. And we wanted to not solely focus on the speed and the volume, but we wanted to still maintain trust and lasting relationships with our members, and they have to trust the system. And that, I think, goes on the other side too, of our team has to trust the system because this is something new for them. And when we talk about how does it approve, like we internally when we talk about how does this approve the loan and explaining that to them, so I think they have to trust the system too.
Yeah, that's a huge part of it. You have to get the buy-in from your team as well. This is something new, even though they know it's going to be easier, it's going to make their jobs a lot easier, it's going to free up that time for them to build those relationships with their members, it's still a little scary. It's something new, and nobody likes change. But I think once your team sees how easy it is and sees how the flow can make things so much easier for them and free back their time, and it does it so quickly and so easily, they're gonna love it, and they're gonna wish they had done this a long time ago.
Yes.
Yeah, and because everything's been so manual, Deb, for your entire team, we were actually able to kind of change up our implementation plan when it comes to go live and actually get there ahead of schedule so we can get your teams comfortable with, you know, the training and make sure that they know what they're doing when it's time to go live. So that's the one great thing about us, is that we have the flexibility to do things like that for credit unions that need a little bit more hand holding.
For
Yep.
sure.
I agree.
All right. So Barb, what helped you read between the lines of vendor demos to see whether a product would genuinely feel different for your members and teams?
Honestly, I think for our team, as a matter of fact, I think it was a love at first sight when we seen the demo. Um, we teased our VP of Consumer Lending a little bit because we're like, don't show it so much on your face, like try to hide it a little. I think we all loved the system right from the get-go. So the bar was set pretty high when we were ready to see some other vendors. From that point, it was really just trying to challenge each of the other vendors when asking, can your product do this or can they do that? Sometimes it would be yes, sometimes no. But with Algebraic, it was different. They didn't just always say yes, but what they said was, well, not today, but that's a great idea. We'll make it happen if you want that to happen. And that was kind of a deal breaker for us. There was so much flexibility. And the other thing would be that my team is very busy. I keep my people very busy. We always have projects going on all the time. With Algebraic, they really assume the heavy load because they want it to be just a switch, right? They want everything done. So when we're ready to go live, we flick a switch and we can go live. So they know everything about our lending journey before we do go live, our vendors, relationships, underwriting, everything. Algebraic will customize the system exactly how we want it, and then we just turn it on, plug it in, whatever. Deployment will be fast and smooth. We're sure of it.
And that's a
It
great
really
point,
is
just
that
because
easy.
the last 2 days we sat in meetings with your lending folks, creating the underwriting criteria, and it's a massive lift in the beginning, but we're going to be doing it. We just get the criteria, we set it up for you versus the legacy platforms. They don't set up for you. They give you this massive system and say, okay, here, good luck. So it's been fun.
Yeah.
Actually, I know I told Josh that it'll painful up front. I said, but once we get to this point, it's going to be easy sailing.
Yep, it's going to be great.
And I do remember her face during that demo, and we kind of laughed about it afterwards because I don't remember what it was that we were showing, but she literally went.
Yeah, we're like,
and you're like,
wait,
stop.
Yeah.
No,
was a
we're
good thing.
still debating. We're still debating.
Yeah, yeah, we don't know yet.
We don't know yet. That was awesome. That was a great demo.
No, it's good.
All right, let's move on. So when boards start looking past vision statements and into implementation details, the questions change. It's no longer, do we need automation? It's what kind of automation belongs here? Over the past year, the data tells us something subtle but very powerful. AI adoption in credit unions jumped 36% year over year, yet satisfaction with digital lending plateaued. Operating expenses increased even after large investments in automation. That tells us technology alone isn't the fix, clarity is. The most thoughtful leaders today are probing 5 things. The first is AI in context. Many platforms say that they use AI, but the key is being able to explain it. When a model declines a loan or flags an exception, can a loan officer see why? In Cornerstone's 2025 survey, more than half of executives said that their biggest obstacle was model transparency. So the real marker is whether intelligence guides users in plain language, not whether it hides behind jargon. AI that explains itself strengthens trust with regulators and members alike, and that's how intelligence earns credibility. Next is automation with boundaries. Many teams learn the hard way that automating judgment is riskier than automating motion. The best systems automate the busy work, collecting data, validation, sending reminders, but lets people make the real decisions. When automation helps people show empathy, efficiency follows. When it replaces empathy, efficiency erodes. We see this in Callahan's data. The process gets faster, but satisfaction doesn't improve. That's because members feel processed and not cared for. Third is unification beyond APIs. Integration is now expected. Every RFP says, we integrate with your core. But when everything works together, the whole journey stays consistent. In TrendWatch Q2 2025, 61% of credit unions still report duplicate data entry across systems. The question to ask is, can a loan officer and a member look at the same screen and see the same progress? That's what reduces drop-offs and manual processes. Unification isn't about plumbing, it's about perception. The fourth is simplicity in the everyday. The systems that endure are the ones that disappear into the workday. A new platform succeeds when your most seasoned loan officers learns it in a week and your newest member completes an application without asking for help. In Cornerstone's research, over 70% of credit union leaders rated ease of use for frontline staff above cost savings as a decision criteria. Simplicity isn't a nice to have, it's the most powerful adoption strategy you can buy. And finally, adaptability for growth. Lending products shift fast. Think EV loans, buy now, pay later, green home credits. The question is whether your system lets you add a new product without a 12-month IT project. In 2025, 40% of credit unions said their core or LOS limited new product rollouts. Adaptability is becoming the new speed, the ability to pivot without pain. So when you combine these 5 markers, you get a new definition of speed. One that's not about milliseconds or macros, but about how smoothly people move through the system. And that's what speed with soul really means. Technology that accelerates trust, not just transactions. So, Barb, when you compared platforms, how did you determine which one truly delivered on these 5 markers?
So how did it cut through all the AI claims and integration claims? That was not always easy. The one thing we did know for sure is that your team, PJ, and the rest of, I know PJ has been studying AI for over 10 years. So that was really important that was integrated for us. With Algebraic, you have the AI companion kind of into each step of the journey. Helps members to not necessarily need to talk to somebody or even visit a branch if they don't want to. And there's other embedded AI technologies like the matching of the driver's license with the live picture selfie, kind of rules out some certain frauds. And it's really just all built into the system. Can detect document tampering like in a pay stub or a monthly statement. So it can kind of like match things up in the core, like their name and address or whatever. So I think Algebraic's stand on AI is kind of what helped push us over the limit to trusting which vendor knew, I guess, what they were talking about as far as integration with AI, if that makes sense.
Yeah, that makes total sense. I mean, when we do demos, we like to explain how we're using AI, how it's utilized within our system, not just, oh, we use it and it's just this magical thing that hangs out in the background. We talk about how we're using it within our system and the examples you just gave and why we're doing it and we explain how it's working. So we don't just want to be one of those other companies that say, oh, we use AI. We actually explain how we're using it and how it matters to you and how it helps with your processes. So
important.
Thank you for that answer. So Deb, which of these, explainability, simplicity, or adaptability felt most urgent for your teams on the ground, and how did that shape your implementation priorities?
I think it was the explainability mattered most for us, because we need our teams to trust the system and to justify the decisions to our members. The priorities that we had were transparent workflows, clear audit trails, easy to understand the decision logic. And then, the lender's cockpit with the dashboard is just amazing. And that was one of our big things that we were looking for too in the system.
Awesome. Yeah, we've had a lot of compliments on that. That was definitely something that was important for us to make sure that the information that we knew loan officers would want to see is right there front and center. One of our product managers, or actually our VP of product, Jesse, he used to be a loan officer. So as a loan officer coming from that world, he put his loan officer hat on and said, okay, if I was sitting in this seat, what would I want the product to look like? What would I want? What kind of information would I want on my dashboard? So, our product really came out of the brain of somebody who used to sit in that seat, which was extremely helpful when producing this product. So thank you for that. So let's take a pause before our last lens. We've talked about empathy and speed, but when you look at your own lending stack, where does the human technology gap still feel the widest?
So are we waiting on a poll to pop up here?
There we go. So where do you think the biggest gap still exists between humans and technology in lending? Is it transparency and decisioning, simplicity of communication, human-like guidance throughout the process, predictable and consistent outcomes, or none? Trust still needs a person.
While we're waiting, we can see if Deb and Barb want to give us their answers on these.
I feel like this is a tough one. Is the biggest gap? I guess I think it'll always be human-like guidance throughout the process when AI is involved. It's just something that we always have to keep top of mind. That was my thought. Deb, what do you think?
Yeah, I think, and I agree with that, and transparency in the decisioning too. Because, that's the loan officers looking at, the yes or no too with the members. So I think that's important also.
Yeah, so most of the people agreed that human-like guidance throughout the process. We still had several people say none, that trust still needs a person, which, we're not here to replace people. The technology is not going to replace people. It's just going to make the process better. And I think that's what we're trying to get across today. So interesting. What do you think, Jennifer?
Yeah, I kind of feel like there was a few different answers that could have been given, but I still feel like they want to feel that human touch. I'm surprised to see the none actually. So I feel like there's a ton of ways you could add AI with still having a human touch. And I think credit unions are doing it today. They're just not doing it to the extent that that our platform is able to do, because we have the ability of using not just the chatbots, but also the agentic AI. A lot of them do include the generative, but they don't have the ability to do the agentic, which is what moves things around automatically. All right, well, let's go ahead and move on to the next slide. Okay, so when we talk to credit union leaders after their core transformation projects, there's one realization that keeps coming up. We made the system faster, but not necessarily better for the people using it. That's why after empathy and efficiency, the next lens of assessment is experience readiness. Not the glossy service level experience, but how deeply the platform supports every participant, borrower, loan officer, and leader. Across the board, 5 experience markers consistently set apart projects that take off from those that get stuck. The first is borrower clarity. Most drop-offs still happen when the members feel unsure. Was my document received? Or am I approved yet? The most forward-looking credit unions now evaluate tech by how well it removes that uncertainty. Does the borrower always know where they stand? Guided workflows, status visibility, and human-sounding progress cues may look small, but they directly reduce abandonment. Transparency is now a design choice and a loyalty lever. The second is loan officer empowerment. You can't deliver great member experiences on the back of frustrated loan officers. The question evaluators are asking is, does this platform anticipate what my loan officers need next? The best system surfaces the next action. Review pending docs, decision ready, member awaiting for an update, without making them jump across screens. Simplicity here drives morale, adoption, and ultimately NPS. A modern LOS or POS isn't just a tool, it's an assistant that clears space for empathy. Third comes AI-assisted judgment. We've all seen AI used for speed, but for the smarter credit unions now test how well it explains itself. When evaluating, the question isn't just, does it use AI, but does it show confidence levels, rationales, and clear escalation paths? A system that says why builds trust with the auditors, the regulators, and the loan officers alike. It turns AI into a partner in judgment, not a replacement for it. That's the real marker for maturity. Explainability, not just intelligence. The fourth is continuity of experience. Most lending stacks still behave like separate islands: origination, decisioning, servicing. The assessment question here is, when a member moves from one phase to another, does their story travel with them? Leading credit unions are now scoring vendors on data and tone continuity, making sure context, conversation history, and intent carry through. Because when continuity breaks, trust resets. A system that remembers feels human. And the final marker is experience analytics. For years, we've measured lending by volume and turnaround time. But the best teams now measure experience as a KPI. They ask, where are borrowers dropping off? Which loan officer screens cause the most delays? How does NPS vary by loan type? Platforms that turn experience into visible metrics let you refine empathy like you refine credit policy. It's not just qualitative anymore. It's measurable, actionable, and tied directly to performance. These 5 experience markers complete the framework. From what we value, to how we measure velocity, to how we ensure the people in the system actually feel the benefit. Because the real test of modernization isn't what a platform can automate. It's whether it helps everyone in the journey do their best work. So Barb, during evaluation, how did you assess the borrower and loan officer experience in each solution? And then was there a clear signal that told you this one feels right for both sides?
Well, definitely it was that love at first sight thing. I'm not really kidding about that. But the journey for both the loan officer and the member looked the same. They were probably the most similar than any other application we've seen. So the consistency of online or in branch, that was important to us. Kind of like something you stated earlier in your screen, simplicity in the everyday. Among many of the other efficiencies of doing everything one platform without changing which screen you're working on, or the training portion, how it would take much less time. Also, the task list will help keep the process moving along, not only with automation, but clearly identifying what the loan officer or underwriter's next step is, really to both the loan officer and the member. Reducing the time to process from, and we think anywhere from like what was taking an hour could take a quarter of an hour. So.
Well, hopefully even less for an unsecured loan, right?
Well, right.
From start to finish, you could probably be done in less than 5 minutes. So
That'd be
I'm going to go
great.
ahead for time check. We have about 10 minutes. So I'm going to go ahead and flip to the next slide if you're good with that. So we've just spent the last few slides dissecting what makes great lending, well, great again, right? The irony, of course, is that when you list all these expectations out, human-centered design, automation that explains itself, Connected workflows, happy loan officers, and reassured members. It sounds like the wish list every platform claims to have, right? But if you've ever sat through a core migration or an LOS rollout, you know the reality. Half the energy goes into making 5 systems pretend they like each other. That's where Algebra 1 quietly came in, not as another layer, but as a way to pull the layers together. Think of it this way. If every framework we discussed today was an interview question, Algebric's the one that finally answered in a full sentence. It's not here to impress with acronyms. It's built to help people feel whole again. The borrower, the loan officer, the data, and the decision, all moving in one rhythm. And honestly, after spending months obsessing over empathy, speed, and experience, the only promotion anyone deserves is seeing it all actually work. So moving on to the next slide, we're going to take a moment to connect all the dots we've been talking about. What you're seeing here isn't just about 5 modules or a tech stack. It's a single motion. Every piece of Algebra 1 was designed to flow into the next, so when a member begins a journey, it doesn't stop or restart at every handoff. It starts with digital account opening, where onboarding is instant, identity is verified in seconds, and drop-offs are near 0. Then comes omnichannel, that moment of intent captured wherever it happens, whether it's online or in a branch. The experience is the same. The lender's cockpit becomes the control tower, orchestrating verification, documentation, and decisioning without the human bottlenecks. The decisioning engine routes approvals adaptively, using data and AI to lift conversion rates by hundreds of basis points. And then finally, portfolio analytics closes the loop. It brings intelligence back into the system so every loan improves the next one. Credit unions have always wanted this kind of unity, but until now, they've had to build it piece by piece. Algebra 1 makes it the default, a platform that thinks and moves as one. So Deb, I'm going to ask you one question here. You have evaluated multiple platforms before choosing Algebraic. When you looked at this end-to-end flow, what stood out? Was it the ability to unify systems, the promise of better conversion metrics, or the potential to give your teams more visibility into the entire lending process?
I think it's like super short answer. It's the unity of the systems because Algebraic has every piece of the puzzle that we were looking for all in one. And, that was really it for us.
That's great. And it's actually much easier to have everything all in one instead of,
Yeah.
adding, tech on top of tech. So I think at
We
this
did-
point, go
Well,
ahead.
we did have a question from somebody on the call. They asked, what made Algebraic unbeatable and why Algebraic over the others? So I think both Barb and Deb have answered that already, but Barb, you want to give that a shot?
I think it's everything we've all talked about today. It's the friction going away, the efficiency is being seen, the member being able to interact with us both digitally and human-like. I think it just checked all the boxes for us.
Yeah, us too.
Awesome. And then we did have another question on tactical and procedural change that built staff confidence. So what do you think your staff saw that made them confident that Algebraic was going to be the right system to replace what you're currently using?
For us, I think that it was the efficiency and the flow. Also, when we first started our meetings with Algebraic and we were looking at the other platforms, one of the things, and I don't know if this applies to it, but during one of our sessions, we said, well, we really need to have digital account opening and it needs to work. And you guys weren't exactly ready for it yet. And you came back like within a week and you were like, we'll have it for you. And it was like, just the fact that you listened to us, that was the biggest thing, is that you were listening to what we needed. We weren't just buying your product. You listened to what we needed and you're making this what we need as our credit union, probably doing the same thing for Barb. So
I was going to
that was
say,
one of the big things.
I not only echo that, but we basically said, hey, can we help? Can we help you design it so that it, looks and feels like we want? And they're like, sure.
Yeah.
So that was pretty huge.
I will
It
tell
was
you,
huge for us
joining.
too.
So
Yeah, it
since
was
I
huge for us
joined
too
Algebra,
because, go ahead,
no,
go ahead.
I was just gonna say, Andrea, since that was the most exciting thing for me, because I've been on 5 months and coming from being on legacy platforms when I sat through these demos, and it was like, oh, that's a great point. Yeah, we should consider that. It just, I guess being having the flexibility to customize it to what you guys are looking for is massive, because the platforms I was
Awesome.
on, it was, you get what you get. You get the fields and you don't want to use them, fine, but we are not going to customize it to what works best for your credit union. So that's what was so exciting for me.
Yeah,
Right.
and not only that, yeah, maybe we can change it, but it's going to be a 6-month project or whatever, you know.
Right.
If we can even get to it. Yeah.
Right.
But yeah,
Mhm.
and you know, that was one thing, again, when we were building out this product from the brain of our VP of product management, Jesse. Again, he said, I was using systems that had all these buttons that I never used. So if I never used them, why are they there? So we really wanted to make our product very simple, very simplistic, so it wasn't bogged down with a bunch of stuff and buttons that didn't need to be there, unless it had to be there because that was the flow. Then it would show up, but it wasn't just there to be there. And so we really took that into consideration when we were building out our platform. And with the help of not only Barb, your team, and Deb, your team, you know, we're all the demos that we've done over the last 12 months, we've listened to that feedback and we've incorporated a lot of that feedback within our platform, because we want to make it what credit unions want to see and want to use, and what they've been missing for the last so many years, and something that they've been wanting for so long.
And that's exactly
So,
what it is.
yes.
Yep.
All right, Jennifer, do we have
Yeah.
one more slide to cover?
No, this is the cover we're on right now. I'm gonna go ahead and just close this out. We have 3 minutes left. So we're at the end, but we wanted to share that you'll get a small kit from us after this. It's called the Lending Maturity Map, which is a breakdown of new rules shaping modern lending and a few quick tools to help you benchmark where you stand. But the real highlight is something we're launching today, the State of AI and Lending Survey. It's the first nationwide effort to capture what credit union leaders are actually seeing, where AI is helping, where it's overhyped, and what's slowing down adoption. This isn't a marketing survey. We're building an industry-first report with early adopters, publishing it in January. And to make it worth your 2 minutes, we're giving away 2 gift cards totaling $1,000 to those responders. You'll get the link right after this session, and we'll paste it in the chat. Just filling out the first page enters you. Thank you, Barb and Deb, for your input today. It has been extremely valuable. Thank you to everyone who joined us on our webinar. We appreciate you taking an hour of your day to spend with us.
Thank
Happy
you
to
for
be here.
having
It
me.
was fun.
All right. Thank you, ladies. Thanks everyone who joined us.
Thank you.
Bye-bye.
Bye.
Bye.